I need to talk to you about something I am seeing in the real estate market right now that genuinely worries me. Over my 7 decades of investing, I have watched people make the same mistakes over and over again in different markets, in different asset classes, during different time periods. The specifics change, but the underlying errors in judgment remain remarkably consistent. And right now, in 2025, I am watching real estate investors make what I consider to be a fatal mistake. Not fatal in the sense that it will kill them physically, but fatal in the sense that it could destroy their financial futures in ways they will not recover from for decades. This is not about being anti-real estate. I own real estate. Berkshire Hathaway owns real estate through our various subsidiaries. Real estate can be an excellent investment under the right circumstances. But circumstances matter enormously, and the circumstances today are about as unfavorable for real estate investors as I have seen in my lifetime. And yet, people keep piling into real estate deals, keep borrowing money to buy properties, keep convincing themselves that they have found some special opportunity that will make them wealthy, and they are setting themselves up for catastrophic losses. Let me be very specific about what the fatal mistake is, because I do not want there to be any ambiguity about what I am warning you against. The fatal mistake is buying investment properties with the assumption that appreciation will bail you out of poor cash flow. Let me say that again in different words. The mistake is paying prices for properties where the rental income does not adequately cover your expenses and debt service, but convincing yourself that it is okay because the property will increase in value and you will make your profit when you sell. This is not investing. This is speculation. This is the greater fool theory. This is assuming that someone will come along later and pay even more for the property than you paid, even though the fundamentals do not support the current price, let alone a higher price. And this approach works wonderfully until it does not work at all. Then it destroys you financially in ways that are difficult to overstate. I have seen this movie before. I saw it in the early 2000s, leading up to the housing crash of 2007 and 2008. People were buying houses and condos with no money down, with adjustable rate mortgages they could not afford in markets where prices had been rising rapidly. They were not buying these properties because the rental income made sense. They were buying them because they expected prices to keep going up. Flippers were buying properties, doing minimal renovations, and selling them a few months later at higher prices. Everyone was making money. Everyone was a real estate genius. And then the music stopped. Prices stopped rising. Then they started falling. And suddenly people who had bought properties expecting to flip them could not find buyers. People who had stretched to buy rental properties found that the rent did not cover their mortgage payments. Adjustable rate mortgages reset to higher rates that borrowers could not afford. Foreclosures exploded. Property values collapsed. Trillions of dollars of wealth evaporated. And millions of people who thought they were building wealth through real estate ended up bankrupt or severely damaged financially. I remember talking to people during that period who insisted that real estate was different, that it always went up over time, that you could not lose money in real estate if you held long enough. These people learned very painful lessons about leverage, about liquidity, about what happens when you own an asset that is declining in value while you still owe money on it that you cannot pay. Some of them are still recovering financially almost 20 years later. And now I am watching the same patterns emerge again. Different specifics, different locations, different types of properties, but the same fundamental mistake. People are paying too much for properties relative to the income those properties generate. They are using leverage, borrowing heavily to make these purchases, and they are assuming that appreciation will make everything work out. Let me walk you through why this is such a dangerous mistake and why I think the consequences over the next few years could be even worse than what we saw in 2008. First, let us talk about valuations. Real estate prices in most markets are at or near all-time highs relative to rental income. You can measure this in different ways: price-to-rent ratios, cap rates, cash-on-cash returns. By every metric I look at, properties are expensive. In a healthy market, a rental property should generate enough income to cover all of your expenses, including the mortgage payment, property taxes, insurance, maintenance, vacancy allowance, and property management if you use a manager. And after covering all of those expenses, you should have positive cash flow. That positive cash flow is your return on equity. That is what makes real estate a good investment. You are generating income from the property while also benefiting from mortgage paydown and potential appreciation over time. But in today's market, most rental properties do not generate positive cash flow, at least not if you are buying them at current market prices with typical financing. Let me give you an example with realistic numbers. Suppose you buy a single-family rental property for $500,000. You put down 20%, which is $100,000, and finance $400,000 at 7% interest for 30 years. Your monthly mortgage payment is about $2,650. Property taxes, let us say 1.2% of the property value annually, which is about $600 per month. Insurance, maybe $200 per month. Maintenance and repairs, you should budget at least 1% of the property value annually, which is about $400 per month. Vacancy allowance, assume the property sits empty 1 month per year, which is 8.3% of gross rent. Property management, if you hire someone, typically 10% of rent. Add all of that up and you have about $3,850 per month in expenses before even accounting for vacancy and management fees. And this is assuming nothing major goes wrong, no major repairs, no extended vacancies, no problem tenants who stop paying rent and need to be evicted. In reality, your expenses will often be higher. So what rent would you need to charge to break even? At least $4,000 to $4,200 per month when you account for vacancy and management. And to have healthy, positive cash flow, you really need to be collecting $4,500 to $5,000 per month. But can you rent a $500,000 house for $4,500 to $5,000 per month in most markets? In some high rent markets like San Francisco or New York, maybe. But in most of the country, a $500,000 house rents for $3,000 to $3,500 per month, which means you are losing $500 to $1,000 per month in negative cash flow. You are paying money every month out of your pocket to own this property. Now, some real estate investors will tell you this is fine. They will say that the property will appreciate, that you are building equity through mortgage paydown, that the tax deductions offset the negative cash flow, that rents will increase over time, and eventually the property will be cash flow positive. And there is some truth to each of these arguments, but they are dangerous rationalizations that have led countless investors to financial ruin. Let me address each one. First, the assumption that properties will appreciate. Maybe they will, maybe they will not. Real estate is cyclical, prices go up and prices go down. If you buy at the peak of the cycle, which is where we are now in most markets, you could easily see flat or negative price appreciation for many years. During the 2008 crash, properties declined 40, 50, even 60% from their peaks in some markets. It took over a decade for prices to recover in many areas. If you buy a property today for $500,000 and it declines to $350,000, you now owe more on your mortgage than the property is worth. You are underwater. You cannot sell without bringing cash to the closing table to pay off the loan, and you are stuck paying negative cash flow every month on a property that has lost value. This is a financial nightmare. Second, the argument about building equity through mortgage paydown. Yes, every month, part of your mortgage payment goes toward principal, which increases your equity in the property. But in the early years of a mortgage, the vast majority of your payment is interest, not principal. In my example, with a $400,000 loan at 7%, your first month payment of $2,650 includes only about $700 of principal. The other $1,950 is interest. So yes, you are building equity, but very slowly. And that equity building is more than offset by the negative cash flow you are paying every month. If you are paying $1,000 per month in negative cash flow, that is $12,000 per year out of your pocket. Meanwhile, you might be building $8,000 or $9,000 in equity through principal paydown. You are still losing money every year on a net basis. Third, tax deductions. Yes, Mortgage interest and property expenses are tax deductible if you own rental real estate. This reduces your after-tax cost of the negative cash flow, but it does not eliminate it. If you are losing $1,000 per month in negative cash flow and you are in a 30% marginal tax bracket, the tax savings might reduce your after-tax loss to $700 per month. You are still losing $700 per month. That is $8,400 per year. Over 10 years, that is $84,000 out of your pocket. Fourth, the expectation that rents will increase over time. Yes, rents generally increase with inflation, but they do not increase smoothly or predictably. During recessions, rents often decline as demand weakens and unemployment rises. And even when rents do increase, they often do not keep pace with the increases in your expenses. Property taxes tend to rise aggressively. Insurance costs are skyrocketing in many markets. Maintenance costs increase with inflation. So the gap between your income and expenses may not narrow as much as you expect. Now, let me talk about leverage, because this is what makes the fatal mistake truly fatal. Most real estate investors use debt to finance their purchases. This is considered normal and even smart in the real estate world. People talk about using OPM, other people's money, to build wealth. They talk about the power of leverage to amplify returns. And it is true that leverage amplifies returns when things go well. But leverage also amplifies losses when things go badly. And this is what real estate investors consistently fail to appreciate until it is too late. Let me give you a simple example. Suppose you buy a property for $500,000 with $100,000 down and a $400,000 mortgage. If the property appreciates by 10% to $550,000, your equity has increased from $100,000 to $150,000. You made $50,000 on a $100,000 investment, a 50% return. Leverage magnified your gains. But if the property depreciates by 10% to $450,000, your equity has declined from $100,000 to $50,000. You lost $50,000 on a $100,000 investment, a 50% loss. And if the property declines by 20% to $400,000, your equity is completely wiped out. You owe as much as the property is worth. If it declines more than 20%, you are underwater, owing more than the property is worth. This is the double-edged sword of leverage. It works wonderfully on the way up and catastrophically on the way down. And when you combine high leverage with negative cash flow, you have created a financial time bomb. You are paying money every month to own an asset that could decline in value, and if it does decline significantly, you cannot sell without taking a huge loss. You are trapped. And here is what makes the situation even more dangerous. Real estate is illiquid. If you own stocks and the market starts declining, you can sell quickly. You might not like the price you get, but you can exit your position in seconds. With real estate, selling takes months, even in a good market. You need to find a buyer, negotiate a price, go through inspections and financing and closing. In a declining market, it can take a year or more to sell a property, and you may need to reduce your price multiple times to find a buyer. During that time, you are still paying all of your expenses. You are still covering the negative cash flow. You are watching your equity decline, and you are powerless to stop it. This illiquidity is a feature of real estate that investors drastically underestimate until they find themselves in a position where they desperately need to sell and cannot. Let me talk about what happens when real estate markets turn down, because I want you to understand the full scope of how bad this can get. It does not happen all at once. It happens gradually, then suddenly. First, sales volume declines. Fewer people are buying. Properties sit on the market longer. This is the early warning sign that most people ignore because prices have not declined yet. They think the market is just taking a pause before resuming its upward trajectory. Then price reductions start appearing. Sellers who need to move cut their prices to attract buyers. These initial price cuts are modest, maybe 5 or 10%. Other sellers see this and think their properties are worth more, so they hold out for higher prices. But buyers now have more negotiating power. They can make low offers and wait for desperate sellers to accept. As this process continues, more and more sellers capitulate and reduce their prices. Buyers become cautious, thinking prices will drop further, so they wait. This creates a negative feedback loop where declining prices cause buyers to wait, which causes prices to decline more, which causes buyers to wait longer. Sales volume collapses. Only desperate sellers transact, and they have to take whatever price they can get. For investors with negative cash flow properties, this is devastating. Every month that goes by, they are paying money to hold a property that is declining in value. They cannot sell because there are no buyers at prices that would let them break even. They cannot raise rents because demand is weak and other landlords are cutting rents to keep tenants. They are trapped in a bleeding asset with no way out. Eventually, many of these investors give up. They stop paying their mortgages. The properties go into foreclosure. The banks take them back and dump them on the market at fire sale prices, further depressing values. This happened on a massive scale. In 2008 and 2009, entire neighborhoods were full of foreclosed properties. Prices fell 40, 50, 60% from their peaks. People lost everything. And it is going to happen again. Maybe not this year, maybe not next year, but it is coming. The conditions are in place. Prices are too high relative to fundamentals. Investors are using too much leverage. Negative cash flow deals are everywhere. Interest rates are higher, making debt service more expensive. The economy is slowing, which will weaken demand for housing. The ingredients for a major correction are all present. Let me tell you what I see that particularly concerns me right now. I see house flipping making a comeback. People are buying properties, doing cosmetic renovations, and trying to sell them for quick profits. This only works in a rising market. In a flat or declining market, flippers get destroyed. They bought at peak prices, they invested money in renovations, and they cannot sell for enough to cover their costs. They end up taking losses or holding properties they cannot afford to hold. I see short-term rental investors, people buying properties to list on Airbnb and similar platforms.
These investors are paying even higher prices than traditional rental investors because they expect to earn higher rental income from short-term guests than from long-term tenants.
But short-term rental markets are becoming saturated. Regulations are tightening in many cities. And in a recession, travel and tourism decline sharply, which means short-term rental income collapses. These investors are particularly vulnerable because their business model depends on discretionary spending by travelers. I see real estate syndications and crowdfunding deals where promoters are raising money from passive investors to buy properties. Many of these deals have very aggressive projections about rental growth and appreciation. The promoters earn fees regardless of whether the investments work out. So they have an incentive to do deals even when the numbers do not make sense. The passive investors are the ones who will bear the losses when these projections do not materialize. I see commercial real estate investors buying office buildings, retail centers, and apartment complexes at prices that assume occupancy and rents will remain strong. But office demand has collapsed due to remote work. Retail is challenged by e-commerce, and apartment construction has been so aggressive in some markets that there is oversupply. These commercial investors are going to face severe stress as their properties underperform. All of these different types of real estate investors are making the same fundamental mistake. They are paying too much, using too much leverage, generating inadequate cash flow, and assuming that appreciation will save them. And they are going to learn painful lessons when the market turns. Now, let me tell you what you should do if you are thinking about investing in real estate or if you already own investment properties. First, if you are thinking about buying investment property in today's market, my advice is simple. Do not wait. Prices are too high. The risk-reward ratio is terrible. You are much more likely to lose money than to make money buying at current valuations. I know this is not what you want to hear. I know you are worried about missing out, about prices going even higher, about not getting into the market. But patience is rewarded in investing, and this is a time to be patient. If you absolutely must buy real estate, then follow these rules. Only buy properties that generate positive cash flow from day one. And I do not mean barely positive. I mean meaningfully positive. with at least a few $100s per month in profit after all expenses, including vacancy and management. This positive cash flow is your margin of safety. It protects you if rents do not rise as expected. It protects you if expenses increase. It protects you if the property value declines. Use conservative assumptions in your analysis. Assume higher vacancy than you think you will have. Assume higher maintenance costs than seem necessary. Assume lower rent growth than recent trends would suggest. Underwrite the deal conservatively and only proceed if it still makes sense. Most real estate investors make the opposite mistake. They use optimistic assumptions to justify deals they want to do. Do not do this. Be conservative. Be pessimistic. Only buy when the deal works, even under adverse scenarios. Use minimal leverage. The less you borrow, the lower your risk. I know this reduces your returns if the property appreciates, but it also dramatically reduces your risk of catastrophic loss if values decline. If you can buy properties with all cash, that is ideal. If you must borrow, keep your loan-to-value ratio below 60%. This gives you a substantial equity cushion that can absorb price declines without putting you underwater. Focus on properties in markets with strong economic fundamentals. Growing employment, population growth, diversified economy, good schools, low crime. These are the markets that will hold up best in a downturn and recover fastest when conditions improve. Avoid markets that have seen extreme price appreciation in recent years. Those are the markets most likely to see significant corrections. Avoid markets dependent on a single employer or industry. Avoid markets with high crime or failing schools or poor economic prospects. Buy properties you would be happy to hold forever. Do not buy with a plan to flip in a year or two. Do not buy assuming you will sell in 5 years at a much higher price. Buy properties that make sense as long-term holdings, that generate good cash flow, that you would be comfortable owning for decades, if necessary. This mindset will protect you from making speculative bets that depend on everything going right. Now, if you already own investment properties, you need to assess your situation honestly. Are your properties generating positive cash flow? Are you underwater on your mortgages, or do you have meaningful equity cushions? Are you in good markets or struggling markets? Are you financially stressed or comfortable? If you own properties with good cash flow, low leverage, and strong equity positions, you are probably fine. Hold those properties, keep collecting rent, continue paying down your mortgages. You will weather any downturn and come out in good shape on the other side. These are the kinds of properties that build wealth over time. But if you own properties with negative cash flow, high leverage, and little equity, you need to seriously consider selling now before the market turns. Yes, you might miss some additional appreciation if prices keep rising for a while longer, but you are also avoiding the much larger risk of getting caught in a declining market with properties you cannot afford to hold. The risk-reward ratio strongly favors selling and getting out. If you have multiple properties, consider selling the weakest ones even if you keep the strong ones. Reduce your exposure. Build up your cash reserves. Reduce your leverage. Position yourself defensively so that you can survive a downturn and even take advantage of opportunities when they arise. And if you are stretched financially, if you are struggling to cover negative cash flow, if you are using credit cards or home equity lines to fund your real estate investments, you need to sell immediately. You are in a very dangerous position. You are one unexpected expense or one lost tenant away from a financial crisis. Get out now while you still can before you are forced to sell at much worse prices later. Let me address some of the counter-arguments I know I will hear. Some people will say that real estate has always been a good long-term investment that you cannot lose if you hold long enough, that rents and values always recover. This is not true. There are markets where real estate has been a terrible investment for decades. There are properties purchased in the 1980s that are still worth less in inflation-adjusted terms. There are investors who held through downturns and never recovered financially. The idea that time heals all wounds in real estate is a myth perpetuated by people who made money in rising markets and who want to encourage others to buy. The reality is that if you overpay, if you use too much leverage, if you buy in the wrong market at the wrong time, you can suffer permanent capital losses regardless of how long you hold. Others will say that I am just old and conservative, that I do not understand modern real estate investing, that things are different now with technology and new financing methods and global capital flows. I have heard these arguments before. They are always wrong. The fundamentals of real estate have not changed. A property is worth the present value of its future cash flows. If you pay more than that, you are speculating, not investing. This was true 100 years ago, and it is true today. Some will point to inflation and argue that real estate is a good inflation hedge. This is partially true. Rents do tend to rise with inflation over time, but property expenses also rise with inflation, often faster than rents. And if you bought with a mortgage, your nominal debt stays constant while inflation erodes its real value, which is good. But this only helps if you can hold through the inflationary period. If you are forced to sell because of negative cash flow or because you cannot refinance maturing debt, the inflation hedge does not help you. Others will say that their market is special, that demand is uniquely strong where they invest, that prices cannot decline because of limited supply or population growth or some other factor. Every market thinks it is special. Every market has a narrative about why it is different. And yet, almost every market experiences booms and busts. The specifics vary, but the pattern is consistent. Do not convince yourself that your market is immune to the forces that affect all markets. Let me tell you what I think is going to happen over the next few years. I think we are going to see a significant correction in real estate prices in most markets. Not everywhere. Some markets will hold up better than others. But most markets that have seen strong appreciation over the past decade are going to give back a substantial portion of those gains. 20 to 30% declines would not surprise me. In some overheated markets, 40 to 50% declines are possible. This correction will be triggered by some combination of factors. Rising interest rates making mortgages more expensive, economic weakness reducing demand, overbuilding creating excess supply, tightening lending standards making it harder to get mortgages, investor capitulation as negative cash flow becomes unsustainable. The exact catalyst does not matter. What matters is that prices are too high relative to fundamentals, and fundamentals always win eventually. When this correction happens, it will devastate investors who bought with the assumption that appreciation would save them. They will find themselves trapped in properties they cannot sell, cannot rent profitably, and cannot afford to hold. Many will lose everything. Some will declare bankruptcy. Some will have their properties foreclosed. Some will spend years or decades recovering financially. And it will be completely avoidable. They will have had warning. They will have had the opportunity to sell, to reduce leverage, to build cash reserves, to position defensively, but they will have ignored the warnings, because ignoring warnings is what people do when things are going well. It is human nature to assume that current conditions will persist, to extrapolate recent trends into the future, to believe that you are smarter or luckier than those who lost money in previous crashes. I am giving you this warning now because I have seen this movie before. I know how it ends. And I do not want you to be one of the people who loses everything because you made the fatal mistake of buying real estate with the assumption that appreciation would bail you out of poor cash flow. Real estate can be a wonderful investment. I have made a lot of money in real estate over my career. But it is only a good investment if you buy right, if you generate positive cash flow, if you use reasonable leverage, if you have a margin of safety. If you violate these principles, if you pay too much and borrow too much and assume everything will work out because prices will rise, you are not investing. You are gambling, and the odds are against you. The fatal mistake that real estate investors are making right now is confusing a bull market with genius. They think they are smart because they have made money as prices have risen. They think they have discovered some secret or special skill, but they have not. They have simply been in a rising market where almost everyone makes money, and they are going to discover the difference between skill and luck when the market turns. Do not make this mistake. Do not assume that recent price appreciation will continue. Do not buy properties that do not generate positive cash flow. Do not use excessive leverage. Do not convince yourself that your market is special or that you will see the downturn coming and get out in time. These are all dangerous delusions that have destroyed countless investors. Be patient. Be conservative. Wait for genuine opportunities. where the numbers work, where you have a margin of safety, where you are buying value rather than hoping for appreciation, those opportunities will come. They always do. Markets are cyclical. Prices go up and prices go down. And the best opportunities always emerge after corrections when prices have fallen and sellers are desperate. Position yourself to take advantage of those opportunities rather than being one of the desperate sellers. Build your cash reserves. Reduce your leverage. Sell properties that do not make sense. Strengthen your financial position. And when the correction comes, when prices have fallen and everyone else is panicking and refusing to buy, that is when you deploy your capital. That is when real wealth is built in real estate. This is the fatal mistake. Buying investment properties with the assumption that appreciation will bail you out of poor cash flow. Do not make this mistake. It will cost you dearly. Learn from history. Learn from the mistakes of others. Protect yourself. Be patient and invest in real estate only when the fundamentals clearly support it, not because you are afraid of missing out or because everyone else is doing it. Your financial future depends on getting this right.